Small cap stocks are cheap. That's good news, finally. An investment that is cheap, but it's actually got some bad news to it as well. I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Small cap stocks are cheap. I've been looking for that cheap investment since the economy started emerging from the COVID shutdowns. The market got expensive and got expensive quick. If you've ever sat in my office since the pandemic, I've shown you the chart of the price to earnings ratio, but not just any PE ratio, the forward PE ratio. I'll explain in a minute. And I show you how it dipped during March and the spring of 2020, but it never even got cheap at that point. We were trending high and then it dropped. And then we went right through that average as well and went straight up to the second highest forward PE on record ever. It's been coming back down as earnings have come back, but still. So, all right, the PE ratio, the price to earnings ratio, is one of the ways that you can look and that savvy investors can identify, well, is this stock market cheap or expensive? Okay, is this high valuation or overly valued, or is it undervalued? Something like that, right? And so the price to earnings ratio. Now, to me, I don't care much about price to reported earnings. I don't, because the stock market, believe it or not, is a leading indicator. It's always forward looking. The stock market is going to move before the economy does, because it's the epitome of, okay, what have you done for me lately? It doesn't really care much about the past. It cares where are we going, and traders are anticipating that and changing prices, reflecting that price change, and they're buying and selling. Okay, so the price to previous earnings, I don't really care. Price to forward earnings or projected earnings, I think that is a much better measure. Now, more and more companies are not providing that expected earnings. They don't want to give guidance, because then they're locked into painted into a corner or whatever. And so, but expected earnings, so price versus upcoming or expected earnings. So where that peaked was around 22 times back in the late 90s. And just so you know, Alan Greenspan, the famous Federal Reserve chairman, in 1996 said the market's getting irrationally exuberant. That was at a time, guys, where the price to forward earnings was not way out of whack. It was high on relative terms, but it wasn't, exaggerated. But he said, listen, the market is overly optimistic. Irrational exuberance. No one's saying that right now, by the way. No one is. The Fed is actually saying, oh, this is normal, things are fine. I don't trust him. But that was in 1996. The market continued getting higher. That price to forward PE, that price to forward earnings, continued creeping higher for another 5 years, okay? And if you would have just trusted Alan Greenspan at that time in 1996, you would have missed out on a huge rally. Yeah, the stock market then crashed, but it crashed all the way down to the level it was at when Alan Greenspan gave the warning. There's no perfect way of timing this. All right, so really high during the tech bubble. That's why they call it a bubble. That forward PE was very high. 2008, no one wanted to own anything, and so it was low. It was below average. And like I said, right now, we are at the second highest level in history, around a 20 times multiple of that forward PE. So S&P 500 stock market, on average, you'd say, based on that historical context, it's expensive, okay? Doesn't mean it's going to crash tomorrow, but it's high. It's valued high. Could the economy, could the earnings grow into this? Sure, absolutely. We'll just have to see. Now, take a look at this chart. Whew, this is good. I like this. S&P 500 compared to the S&P 600. So the S&P 600 is an index of small capital stocks. So when you compare that price to forward earnings, that forward PE ratio of the S&P 500 compared to that of the S&P 600, so large caps compared to small caps, we are trending lower. We are at the second lowest point in 20, or the lowest point in 20 years, compared to, hey, how expensive is our large cap stocks compared to how expensive are small cap stocks? So in the full scheme of things, or on a relative basis, small cap stocks are cheap relative to large cap stocks. That's good news, because in an area where everything in domestic investing is expensive, small cap stocks appear cheap. Bonds appear expensive. Real estate appears expensive, right? We could very well be in a real estate bubble. Large cap stocks seem expensive. Small cap stocks on a relative basis look cheap. That's good news. Here's the bad news. What happened in the markets the last time small cap, this ratio between forward PE of large compared to forward PE of small, got this out of balance? What happened last time? The lost decade. That's right. Where the S&P 500 or large cap stocks went on a 10-year run where the average rate of return over that 10-year time period was negative. Average was negative. But if you look at this chart here, the average return of small cap stocks and mid cap stocks during that exact same time was positive. Not just positive, but decent 6% rate of return, which is why if you only invested in the S&P 500 leading up to 2000, because you said, look, this is all I need. This is all anyone ever needs. Just keep doing this. Just do half of this. I'll be happy. And then you stuck to that during the next 10 years from 2000, or basically from 99 to 2009, you would have seen a negative return, negative average return over those 10 years. But if you were diversified, you would have had a positive 6% per year over that time period. Would you have had ups and downs and rebounds? Absolutely. Absolutely. But it would have been a manageable, palatable rate of return, hopefully keeping you on track for your financial goals. So that's the takeaway. That's the takeaway. Guys, the large cap stocks, S&P 500, is just clobbering any other major index and has done so for the past arguably 12 years. We just did a full show on the Wise Money Show about this. Hey, is international investing dead? And we get into more detail, but I mean, part of it is, listen, it hasn't even been fair. Hasn't even been fair. If you look back over history, there are 10-year time periods where international wins, U.S. wins, international wins, but this time period, the past 10 years, 12 years, hasn't even been close. The place to be is the S&P 500. So of course, when you look at a relative basis, the S&P 500 is going to be expensive compared to other places that haven't performed as well. But if you zoom out, and I mean zoom out to before the Great Depression, small caps tend to outperform large caps. There's greater risk, and you tend to be rewarded for that risk over the long term. And we might very well be entering a season where small cap is about to outperform as well, just on a historical perspective, looking at the valuation of large caps relative to the valuation of small caps. So should you sell out of that S&P 500 index, buy the small cap index? No. Be diversified. Be diversified. Make sure that philosophy fits with your overall financial plan and your financial goals. Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.